Welcome to our series of educational videos on technical analysis. This is part 2, charting patterns. I'm Michael Gable, Managing Director of Fairmont Equities. Please ensure you are familiar with our disclaimer in that any advice is general advice only. The first part was an introduction. In this part, I'll show you some common charting patterns with some practical examples. Later on, we'll go through candlestick reversals, indicators, Elliott wave, and then finally how to combine both technical and fundamental analysis. For those not familiar with us, Fairmont Equities is a share advisory firm helping clients achieve higher returns from their share portfolios by combining both fundamental and technical analysis. You may have seen some of our commentary in the specialist media, such as the Australian Financial Review, and I also regularly provide commentary on the Sky News Business Channel. What is a charting pattern? As investors move prices up and down, they tend to produce a pattern within a stock chart. Now, these shapes show us graphically the behaviour of traders in the market, and this means we can make some predictions on what might happen next. When you understand these patterns, you will start to understand when shares might be pausing for a breath, as in the case of a continuation pattern, or when they might be ending a trend, as in the case of a reversal. A continuation pattern occurs during a trend, and it can indicate that a trend is likely to continue even further. This is where a stock is taking a breather for the time being. An amateur trader may see certain price movements occur and believe that they need to exit a position. Often a stock will be heading in the opposite direction to the trend, and an investor could confuse this price action with something a little bit more sinister and they could exit their position too early. However, an investor familiar with continuation patterns could therefore know to stay with a position or even enter a new position in the knowledge that there is further to go with the preceding trend. There are a variety of continuation patterns, so let's look at some examples in practice. One of the most common continuation patterns is a flag. A flag is a continuation pattern that looks like a rectangle. It moves against the trend. That is, if the trend is up, then the flag will see the price move down during that time. Price action, as in other continuation patterns, should be more corrective compared to the impulsive move preceding it. What this means is the chart should look very fast moving when it is trending, but then when it enters a corrective pattern, it tends to slow down and struggle to make much headway. This will be more obvious when we look at some examples now. So here is an example of a flag formation. This is Corporate Travel, which we successfully traded in 2015. The stock spent much of the year going backwards, but if you zoom out and view it on a longer term time frame like we have here, you will notice that the stock was just in a continuation pattern. So here is the point where you will notice the difference between impulsive and corrective moves. This bit here is very impulsive and the stock ran up very strongly. Then as it was easing back, you will notice that it actually struggled to drop much. To get from this point down to this point, it needed to cover a longer distance in time compared to here on the upside, where it made that move just in a matter of weeks. So once we've identified that a flag is forming, it's just a case of waiting for it to break out. And once it does so, it will resume the uptrend. So here you could see the breakout near $11, and then it quickly rallied 50%, almost 50% from that point. A pennant is just like a flag, but the shape looks more like a triangle. So you can see here ARB moving sideways within the channel, within the triangle before it finally broke out. Now this breakout here was my signal to buy it for clients. One thing to bear in mind with these triangles is that the breakout often occurs about 2/3 to 3/4 of the way through the formation. The ascending triangle is similar to the pennant, but the top surface is running horizontal. That is, each of the peaks are around the same level instead of tracking lower. So this is a weekly chart of Premier Investments, and you can see how powerful the breakout was. So from a little over $14 to almost $18 in about 2.5 weeks. So it was a very nice profit in a very short period of time. The cup and handle is also a fairly common pattern. It occurs when you see a drop in the share price that then starts to slow down and creep back up again. It results in a very obvious rounding out here in the share price, and then it normally eases back a bit when it gets to the same level that it started, and that results in this coffee cup shape. The stock then rallies, and often the same distance as the depth of the cup. So if this is the depth of the cup here, and we extrapolate that up here, then we get a target. So this is a pattern that we identified with Cochlear back in 2014. And what you'll notice is the shares actually hit our target, then made a pennant, and then broke out and continued even further for obviously a fantastic return. If you'd identified this formation, and even if you only bought it here, you're still looking at a brilliant return. One thing to bear in mind with these continuation patterns is that they work both ways. In other words, if the stock is trending down, you flip the shape the other way and it still applies for a downtrend. So you can have continuations in uptrends and continuations in downtrends. The same is also true for reversal patterns, that they work at the top of a trend and at the bottom of a trend. So let's have a look at some reversals. So a reversal pattern indicates, as the name indicates, that the previous trend up or down is about to reverse and head the other way. In terms of an uptrend, the common reversals include the rising wedge, the double top, and the head and shoulders. When we're looking at a downtrend, then the reversals are the falling wedge, the double bottom, and the inverse head and shoulders. As I said earlier, you basically flip the formation around and it will apply for a downtrend. So the rising wedge is a reversal pattern, and obviously it will appear towards the end of an uptrend. So the shares are still trading higher, but the range is getting tighter and tighter, as you can see between these blue lines here. So this is different from our continuation patterns in that the triangle is not going sideways. In this case, it is still rising. When it breaks down from the wedge, there is often a lot of volume involved. So here we could see a clear break from that formation, and we can see the very large spike up in volume. So this here is a chart of Qantas, the same one that we saw in part 1 of the video series. We've been warning of this rising wedge on Qantas as it was forming, and now you can see the devastating results of that following through. Often a stock will trade back to the base of the wedge, as you can see here. So this is the base of the wedge, and this is the $3 target that we had for Qantas. But in this case, at time of writing, you can see that it actually fell even a little bit further. A double top is simply when a stock has a second go at a price level but rejects from that. Obviously, 2 attempts here at this price level and 2 failures to push through. So obviously this stock has no business being up there just yet. This is Macquarie Group, and the candlesticks clearly show the selling pressure from this point. Try it again, and we can see clearly it's getting sold after failing at that level. So this is a double top. The head and shoulders is another common reversal. Here we see a series of attempts at a high where the middle attempt is the highest. Because of this, these two attempts here, these two peaks, are referred to as the shoulders, and the middle one here is the head. So shoulder, head, shoulder. And this here is the neckline at a level of quite obvious support. We can only declare it a head and shoulders once this neckline gets broken, which happened here. But when it breaks, we can often see the stock drop to a distance below the neckline, equal to the distance above the neckline on the top of the head. In other words, this distance here, we extrapolate down here, and that gives us a target. And this is a chart of Bendigo Bank over 2014 to early 2016, and you can see that it played out perfectly. So that's the end of part 2. In part 3, I'll look at even more reversal signals, but those based on individual candlestick patterns. If you're not viewing this video on the Fairmont Equities website, be sure to pay us a visit where you can subscribe to our research and see our real stock picks in action. And there's also a free blog that gets updated regularly with my articles and videos.